So the class will start now. So we have Mr. Boye Joseph George Boye George online. So Mr. Boye George, you can start your class now.
Good morning, class. I'm George Gawe, and we are looking at the principle of accounts and economics. And that's what we are looking at this morning. And before that, let's look at the principle, the history, the historical development for accounting. You will know that accounting has been in existence before we were even born. And it didn't start, accounting does not start with us. It started with the ancient Babylonian empires. The ancient Babylonian Empire in the year 4500 BC, then it was really meant for tax collection. It was meant for tax collection, but later began to move up and got to a stage of the papyrus. The papyrus word means paper. It got to the stage of the papyrus, and as it got to the stage of papyrus and calamus, the calamus is the pen, papyrus is the paper and the pen. And so it is always registered. When you get to it, it registers your in, whatever you pay in, and also whatever you paid out. But in AD 850, there was an improvement on that. And by the time it got to 1340 AD, there was an improvement also in Genoa. And the improvement brought about a speedy return of what accounting should be. But all I want you to know is that accounts does not really stay in just one place. There's always an evolution on it. It evolved from one stage onto another stage. As early as 1431, there's this family that used complex set of books, considering to be called the cash book. And this cash book gives us a store book, a wage book, and also a book of income and expenditure. But by the time we got there, you see in Venetia, monks, Lucas Pacioli published the first accounting works in 1494. He published the first accounting in 1494. And from there has been so much improvement on the accounting, so many standards has been set on issue of accounting. And I want to know that the more you go on, the more you have interest in what accounting is, and the more we enjoy the accounting. But in the 18th century to 19th century, different professional bodies, came into accounting. And some of these bodies, in England and down to the USA, there's a different form of what accounting is. And there was an increase because the system of accounting needs to be put in place. And if it's not put into place, there's no way that you will enjoy this word accounting. So you need to understand that the more you grow in the organization, the more of accounting that you begin to look at. But let's quickly move on to old methods and machine used in accounting. Old methods and machine used in accounting. In those days, there are two main, there's one just main, way of recording accounting then. But as we begin to grow up, begin to have different ways of what accounting is. But the first one I want us to share is the spreadsheet. I call it the spreadsheet. We all know what spreadsheet is. In those days, if you have attended a primary school, there's what is called the broadsheet. It's called the broadsheet. Another name for the broadsheet is called the spreadsheet. And the spreadsheet comprises of the names the dates, the particulars, the amount received, amount that is collected, and also the total of the money that is left. But as years begin to go on, there's a new development that the spreadsheet is now transferred into the computer. It's now transferred into the computer. And if you look at the computer very well, you will see that there's a lot of things that are in the computer. And some of those things that you can experience in the computer are, you see the names, you see your account name, the account names, you get your account name, you get description of your account, whether you're on current account or you're on whether you're on current account or savings. But thank God for the new era where we are not just using spreadsheets on the computer any longer, but we are using spreadsheets in every vast area. The spreadsheet program is now called the spreadsheet program. And the spreadsheet program is faster, more accurate to be used than the traditional accounting techniques. You need to know it is faster, it's more accurate, and easier to use than the normal, the normal spreadsheet. Because the moment you type in your account, the next thing that comes into it is that you receive every account of. We're now looking at, apart from that is accurate, it is faster, it is less expensive to maintain. It's generally less expensive, and inside it, you now discover that you can keep the amount of sales that you have done. Apart from amount of sales, you can know what you have bought and so many things that you need to understand in it. Then we are also looking at the early programs such as BC Calc provided 254 rows and 62 columns for entering data and formulae for calculation. 250 rows, and we talk about 62 columns that we can use to get your accounting on. But I want to tell you that spreadsheet is very efficient, like I said, and is part of the computer now. It's not like the other things. Now, let's look at the word general ledger. The general ledger. General ledger for the preparation of financial statements and for establishing multiple income and cost entries. So if you look at your general ledger, you will see that the column is divided into two. It's divided into two, one on the credit side, the other is on one on the debit side, and the other is on the credit side. On the debit side, you have your dates, you have your particulars, you have your amount. Then if there's discount, you have your discount in it. And your account has to balance. Your account has to balance. So on your general ledger, it comprises all your prime entries, the journals, the total of your journals, the balance of your journals. It comprises everything like that. Then we are looking at account receivable. Account receivable, where computers can get your bills out the same day you perform such service as account receivable. Module prepares invoice and customer's account. Now, what we are saying is this: when you have an account, your account now pumps up in a way that you are able to pay your bills through your account or to receive some loans through your account. When they pay you in, it's called the account receivable. You enter your account as account receivable and your account is credited. But when your account is paid out, we call it account payable. Account payable. That means you are paid out a certain amount of money in your account. you paid account. So it's called account payable. An account payable, when computerized, will provide for purchase, order control, invoice processing, payment selection and handling, then check writing and control cash requirements. Now, what does this happen? What does this do for you? It helps you in forecasting. It helps you in forecasting to know, okay, how much comes in or how much goes out at the end of the day. It helps you like that. Then we look at the inventory control. Inventory control modules as multiple functions, such as tracking inventory for both costing, tax purpose, controlling purchasing, and the overall level of expenditure and minimizing the investment. Now, what is stock control? I really want you to understand it. Stock control makes you to control what stock you have, the minimum stock you can have to reorder stocks. What are the minimum level of stocks that you need to have to begin to reorder stocks, or what are the maximum stock that you have before you begin to buy another one? What does it take? These are things that you also need to know. Then subsequently, loss of what? Cash flow. In case if your expenses is becoming more than your income, there's going to be cash loss. There's going to be a loss. And you don't need to make a loss while running a business. That is why your inventory controls begin to do everything for you. Then you'll be able to know the state of your stocks, what to invest, what to buy, and what not to buy again. Now, under the stock inventory control, you need to understand also that is what is called the stock card book. The stock card book. You know, that stock card makes you to know what is out and what is in at a particular time. Then we also look at payroll. The next thing we are looking at is payroll. You know, payroll, which contains, you know, when you print out your payroll, it contains your names, your address, your work, the wages will be paid, the allowances will be paid, and these are what makes up your payroll control. Now, payroll control gives the management the edge or to know that if we pay you, we are not paying more than what we are making. So if you are paying more than what you are making, that's a minus. So payroll is introduced, and one way to do that is that with the general ledger, so that you can automatically set aside the correct amount for pay and other withholding. I think you understand what I'm saying. Now, we are looking at point of sale. Point of sale, many of us don't know what point of sale is. Point of sale, we know it, but we don't really know it is point of sale. It is called the POS. The POS we are using, you know, when we get to our ATM, then we put our, you know, our ATM card, we put it there. We put it there, you know. So what we are saying is this: point of sale module says information at or in the place of the cash registered, including date, customer, credit information, items, and quantity sold. It can produce sales, slip or sales invoice, and report on items, customers and salesperson. Then we are looking at purchasing and receiving. Purchasing and receiving module can represent an invaluable addition. It can generate purchase order and track their fulfillment. You can find out which vendor are delivering what. That is purchasing and receiving. You can track them. You know what they are bringing at the right time. And also, it also helps your inventory. Like I said, your inventories. It will help your stock inventories. Then it also gives you time and saves you the expenses of having to follow up on a partial or incomplete order. Then we look at time and billing modules. Time and billing modules. Time and billing modules reduces manual and clerical works. Simply the billing process prompts you and your partner to bill on time, reduces unbilled work in progress, minimizes unreported time, reducing unbilled time, measures and analyzes non-changeable time, and provides critical criteria to analyze staff performance because of computerizing accounting system. Then we are looking at what is accounting. Now you discover that we don't have just one definition to account. We have different definitions to account, and some of these definitions, there are so many that I am giving the students this as an assignment to go home and give us all definition needed for accounting. What is accounting? I want you to go home and give us all the definition for accounting so that we can move on a bit faster, because we talk about defining. There's so many people that have defined accounting, but somewhere, somehow, there's already some summary of what the accounting is. The summary of what accounting is, and I want us to see the summary. Now, we are looking at the keywords. The keyword from the above, from the definitions. The keyword from the definitions of accounting. Number one is identifying. Identifying. That is financial transaction and other economic event from source documents. To identifying. But I want to know that accounting deals with figures. Accounting figures doesn't just come up. Accounting deals with figures, and different type of figures that accounting deals with. It deals with figures. So we talk about the first one, and we say the first one is what is identifying. The second one is analyzing and recording. Analyzing and recording. When it is identified, then we go into the analysis. We go down to the analysis and the recording. We analyze what have we got, what have we received, or what have we paid out. So we identify transactions into prime books, such as journals and cash book. Prime books, journal, and cash book. Then we are looking at also number 3, classifying and summarizing analysis and recording transactions from the prime books. Now, if you balance your prime book, the balance are carried over to your ledger, and the ledger are transferred down to your trial balance. Then from your trial balance, you are able to make other balances. Then number 4, we look at communicating and interpreting. Communicating and interpreting. The summary itself is an accounting to all interests. Now, we should be able to communicate the findings. Our findings, what we have found, we should be able to communicate it, communicate it to the people that need the accounting. And you need to know who are those people that need the information. The people who need the information. We are now talking of the users of accounting information, to judge the performance and position of the business and also make necessary decisions. Now, if I will not jump it, can we quickly look at the users of accounting information? The users of accounting information, they are, number 1, the organization. The organization itself, they want to know if they are making profits or they are not making profits. You want to know if they are making profits or not making profits, so if you make profits or not. Now, it's mostly used by the managers to know if they are efficient or they are not efficient. So we look at the users of that account. Then we look at the other people that use the account are the shareholders. The shareholders use the account. They use the account to know if to invest our money into your business or not to invest our money to your business. Now, you need to understand also that some business might be, look creative, but in it, if you are a user of account, you'll be able to study that some of the business are already cracked down. Then who are those who also need this? They are called the workers, those employees, those who are working in the organization. They want to know so that they can demand for increase in salary or they go on strike. So you need to understand that if you are not a good user of the accounting, there can be problem also in it. So the employees. Then the people that also use account, they are called the government. The government. And you see, the government doesn't really like you. All they like from you is pay your tax. Once your tax is paid, then we know what we are going to do for you. Now let's quickly look at the importance of accounting. What are the importance of accounting? Now, accounting information can be used for decision making. Accounting information can be used. Accounting information can be used for decision making. We want to look at that. Are we making profits? Are we not making profits? If we have diversification of a product, do we retain those products? Or which product is doing well and which product is not doing well? Do we go for product C or we go for product A? So we need to understand the product. Two, it provides permanent record for all transactions. It provides permanent record. Your debtor account, your sales account, your credit account, your debit account, your sales account. You'll be able to know what are the balance of your account. Three, it helps to determine the profitability of a business concern, to know if you are making profits or not. Four, accounting records are used for tax assessment. Like I told you, the government doesn't like you. All they want is how to pay their tax for them. Therefore, record provide a means by which finances of a business are controlled. You're able to control your finance. You're able to tell them, no, this account is this, and control the finance of your organization. Then five, it helps to prevent fraudulent practice. People changing figures, different, in different ways. You'll be able to change that. Then six, the record provides a means by which the finance of a business are controlled. Now, the next one is the record shows the income and expenditure. It shows your income, shows your expenditure. You'll be able to know if your income is small or your expenditure is so much. So you'll be able to know it. Then eight, accounting record shows assets and liabilities. You'll be able to know what is your asset. You'll be able to know what your liabilities are. Now, a lot of people cannot differentiate between assets and liabilities. They can't differentiate between assets and liability. But for a good accountant, you should be able to do that for you. Then we also look at the next one is accounting records and accounting record aid planning. As an organization, you'll be able to know if your planning system is wrong or your planning system is right. And not only planning, it also gives you a sense of focus so that you can forecast. You can forecast if your accounting is okay. Then the last one is accounting record provide a proof of the financial position of an enterprise. Accounting record provides a proof of the financial position of an enterprise. You'll be able to know your financial position. What is your financial position? Are you making money or you are not making money? Do we invest? Do we diversify? You'll be able to know that. And I've talked about already the users of accounting. We talked about that, the shareholders, the management, the managers, the lenders and providers, your shareholders, the government, your suppliers, the customers. These are your users of accounts, your employee, like we have said before, your competitors. Your competitors, I want you to note that. Your competitors, they want to know your strength. They don't want to know your weakness. They want to know the opportunity at hand against you. They want to also know, yes, the threats. They want to know which way to hit you out. Then your financial advisors also. Now let's look at the characteristics of useful accounting. Let's look at the characteristics characteristics. Number one is relevance. It must be relevant. The accounts must be relevant. Information provided should be that which is required to satisfy the needs of information of users. And we know the users, the government, shareholders, you should be able to satisfy that. But in case it's not satisfying it, that means it's not relevant at all. So we need to know the relevancy in it. Then the other one is comprehensiveness. It must be, complete. If your account is not complete, there's no way it can be relevant. Just forget it. It must be comprehensive, comprehensive enough. You don't skip numbers, you don't skip anything, because everything you have is quantified. Then we'll also look at reliability. Reliability. This will be enhanced if information is independently, verified. The law requires that an auditor, who must be a person independent of the company and the holders of the approved qualification, to verify the accounts published by limited companies. Let me explain that. When we talk about this, we are looking at the accountants. There are two main accountants in the organization. We have the internal accountant and we have the external accountant. Your external accountant is your auditor. Now, must be a certified auditor, must be qualified. And what does it do for you? If your company accountant makes up the statement of account, the government might not recognize it. But if the external auditor should do that, it is well recognized. Then we also look at reliability. Number three, reliability. That this will be enhanced if information is independently verified. The law requires that an auditor, who must be a person independent of the company and the holders, like I've explained. Then we look at completeness. Completeness. Number four, completeness. A company's account should present a rounded picture, or contain snapshots of entire economic activities. Objectivity, the usefulness of information. What we are saying is this: the account must not be empty, it must be complete. There must be completeness in it. Information is needed. The context of the preparing account. So every resources you have, the management must not, play with any figure or removing them. And the external auditor has the responsibility for verifying the account. If the account is okay or the account is not okay. Then we also look at the timeliness. Now, we have a period that our accounts has to be produced. In Nigeria, we have January to December. We call them the accounting period. So within the accounting period, every statement of account must come up into place. Then we also look at the comparability. Information should be produced on a consistent basis so that value comparison can be made with information from previous period and with information. Then we also look at accurate. Every account must be accurate. Inaccurate account is problem. We also look at the economical aspect of it. We want to look at what to produce, how to produce, what to produce, and the cost of production. We also look at simplicity. The account must be easy for people to confirm and to check. And we also look at accessibility. All the users of accounts must be able to access the account, the government and others. And the self-assessment exercises. Number one, let's look at number one. Mention the main characteristics which good accounting information must be possessed. must possess. Mention the main characteristic which good accounting information must be possessed. Number 2, list the users of accounting in order of priority. Users of account in order of priority. Okay, and this is my email. My email is geoba2804 at gmail.com. Geoba is GEOGBA 2800804 at gmail.com. Let me come again. GEOGBA 2804 at gmail.com. Geoba at gmail.com. Do all this and send it to my account. Thank you very much. Before the next class, please have to submit to my Gmail before the next class. Thank you very much. God bless you.
God bless you too. That brings us to the end of this class. Yeah, bye.